Nobody wants to think about something happening to their child, but what if not thinking about it is actually the riskier move? Today, we're diving into one of the most emotionally charged, least talked about financial debates in personal finance: whether you should buy insurance for your kids. Every year, millions of parents write checks for children's life insurance policies. And just as many financial advisors tell them to throw that money into a college fund instead. So who's right? And more importantly, who's selling you something? Let's start with a basic argument for it. Whole life insurance for a child locks in a low premium, sometimes as little as $1 a day, and builds cash value over decades. Think of it like planting a money tree in your backyard, except the tree also happens to pay out if the unthinkable happens. The problem is that metaphor starts to crack when you zoom out and realize a healthy 25-year-old can get term life insurance for roughly the same monthly cost without decades of middleman fees eating into the return. You're essentially prepaying for a product your child doesn't need yet, in a world where insurance products will likely be better and cheaper by the time they actually need it. Now, here's where the mood in the room usually shifts, because the moment someone mentions child mortality, rational thinking gets hijacked by parental fear, and that's exactly the environment where financial products thrive. Insurance companies aren't evil, but they are businesses, and they know that a scared parent is a paying customer. Historically, whole life policies for children have been sold with three promises: guaranteed insurability, cash value accumulation, and financial protection. Of those three, guaranteed insurability is the most legitimate benefit if your child later develops a serious illness. They can't be denied coverage they already hold. But here's the irony. The overwhelming majority of children are perfectly insurable as adults, meaning you've been paying a premium for a decade or more to hedge against a scenario that statistically almost never materializes. It's like buying flood insurance for your house on top of a mountain. The real question isn't whether child insurance can work, it's whether it's the best use of that money. If that same monthly premium went into an index fund or a 529 plan starting at birth, the compounding math over 18 years would likely crush the cash value of any whole life policy. That said, there are legitimate cases where child insurance makes sense. Families with a history of serious hereditary illness, parents who are genuinely uninsurable themselves and want to ensure continuity, or households where the discipline of a forced savings vehicle outweighs the suboptimal returns. Strategy without context is just noise, and your situation is not a spreadsheet. The misconception worth crushing right now is that buying insurance for your child is a sign of love, and not buying it is negligence. That's a narrative, not a fact. Love looks like building generational wealth, funding education, and modeling disciplined financial behavior, not necessarily a policy with your kid's name on it. So what's the actionable lesson here? If you're considering child insurance, start by honestly auditing your own coverage first, because the biggest financial risk to your child isn't their mortality, it's yours. Make sure your term life policy, disability insurance, and emergency fund are airtight before spending a single dollar on a policy for someone who has zero dependents. If you do decide to move forward with child insurance, treat it like a position-sized decision, not an emotional one. Allocate only what you'd be comfortable losing access to for 20 or 30 years. Small, disciplined, unemotional commitment is the only way to make any long-term financial vehicle actually work for you. At the end of the day, the best financial decisions are the ones you can sustain, understand, and sleep comfortably with, not the ones that sound the most responsible at a dinner party. Discipline, consistency, and clarity of purpose will always beat the flashiest product on the shelf. Whether you buy the policy or skip it entirely, the real win is making the choice consciously, with full information, rather than out of guilt or fear manufactured by a sales pitch. And if you're ready to take the next step in building real, lasting wealth for your family, whether through real estate investing, home contracting, work, or finding the right lenders, check out our links in the description below.